We will be, there you go. We will be recording this webinar and distributing the recording to the attendees after the event. We also are planning to hold 10 minutes at the end for questions. So please feel free to use the chat window. We'll monitor your questions and we'll work on getting through and getting them answered at the end. We do have a great presentation planned for you today. We're so thrilled you're all joining us on our first one of the year in 2023. As always, our events, all of these events like this are impossible to put on without our sponsors, our annual sponsors. So as a thank you to them, I'm going to kind of run through them. Our gold sponsors are H. Kulak and Sons and Savings Bank of Danbury. Our silver sponsors, we have BL Companies, Capture Visual Marketing, Cone Resnick, Community Investment Corporation, Dime Bank, Guilford Savings Bank, Munger Construction, Newtown Savings Bank, RD Cinto, and Sherwood Inspection. Please, we always encourage people to visit our website, which is ctccim.com, for more info on all the sponsors and to have links to their websites. You can connect up with each of them and connect with their products and services more. So now I'd like to welcome our guest speaker, Mike Goman. I always think that Mike is a man who needs no intro, though I'll do my best to lay a worthy one out today. His work as a principal of Goman in York, acting as a consultant and advisor, speaks for itself. For over 40 years, Mike's been advising municipalities, corporations, and individuals on commercial real estate investments, acquisitions, and developments. Mike and his team are responsible for so many positive developments in the state, most recently and notable, the East Hartford Cinema conversion. He's always ahead of the game when it comes to how and where the economy is moving, and he'll be sharing some of those insights with us today. So without further ado, Mike Goman.
Well, thank you, Stephanie, and I'll add my words of welcome to everybody that has joined us today. I'm glad to be here and participate again. I think the last one I did with CCIM was in February of last year, so the timing is great. I'm going to go ahead and share my screen here. Make sure I've got the right screen. There we go. Okay, I think I've got the right screen up there. Do I, Stephanie?
Yes, you do. Yep, look
right,
good.
Perfect. Okay, so I'm not going to dwell a little bit on my background. As Stephanie pointed out, you know, I've been doing this all my life, more than 40 years, involved here in the industry in Connecticut for, I guess, going on 26 or 27 years now. And I'm going to jump right into the presentation. I saw this headline in the Wall Street Journal a week or so ago, and I thought, boy, that sort of captures what's going on out there. You know, everything's changing so quickly and so dramatically. When I saw this headline saying the Earth's inner core is reversing its rotation, and I thought, why not? I mean, everything else seems to be changing, and the world is that we knew a few years ago looks much different. So I guess you know, everything is on the move here. So for those of you who have been on this presentation or listened to me in the past, you know, what I typically tend to do is go through sort of an overview of what's going on today in the major sectors of our industry, the commercial real estate industry. And then we'll talk a little bit toward the end about some predictions and a bit of a discussion about where we here at Goman, New York, see the opportunities in the state. So sector by sector, you know, what's going on, I've sort of called it here, characterize it as shifting demand. You know, those of you in the office building business certainly are faced with that shift in demand every day. It's hard to overstate what's changed in that sector. We're seeing CBDs. San Francisco is the latest one that we looked at the other day, where the CBD is virtually 50% vacant. You know, who would have thought that downtown San Francisco ever would have reached that stage? But the reality is that the hybrid and work from home trend that began sort of in the COVID era, really began before that, but was accelerated by COVID. You know, who would have thought that that would have ever occurred? But it's with us today, and the impact's dramatic. We're looking at what normal is. We don't know at the moment what normal is likely to be. We think that as much as 30% of the office space in central business districts is going to remain vacant for some extended period of time. Time will tell, I guess. The outlook is pretty dramatic just in the New York City market alone, and mortgage bonds are 17 billion that are at risk. There are countervailing factors, however, though we think that things that will change this trajectory that we seem to be on include, the increasing unemployment that we're reading about and the tightening up of the job market. That's going to place employers in a stronger position to require people to come back to work in their offices. And we think that the impact of competition will cause that to some degree. In other words, companies will realize that they're more productive when their people are back in the physical office, and they're going to start requiring that, and they'll have the leverage in this tighter job market to do that. We're also seeing employers create incentives to bring people back, everything from, better food choices to exercise venues to different office designs and so on, really increasing the reason why someone would want to go back into the office and start working there. Now, having said that, does that mean it's going to be 40 hours a week back in the office? We don't think so. We think the trend is really going to be, work from home, maybe Friday and Monday, but be expected in the office Tuesday, Wednesday, and Thursday. The long-term impact on office is yet to be seen, I think. But we're working our way through that, and we'll see what it looks like on the next 24 months or so. A lot of this is having the impact you'd expect on valuations and prices. And if we're still seeing this bid-ask gap that I talked about last year when we got together, we think that's tightening up as time goes by, but it's still out there. We're seeing a lot of discussion, far more discussion focusing on this question of utilization rates versus vacancy rates. The big metric a lot of times that everybody kind of leaned on for office building markets was, what's the vacancy? And now it's really how many people are going into these offices, how much of the square footage is being used. So, utilization rates in a lot of markets are still running in the 40%, 30 to 40%. The better markets are reaching in the high 50s, low 60s, but utilization rates remain low. We think that's going to continue for a while. Retail, interesting recovery last year. We saw the closing trends reverse and more stores being opened. That's the first time in a few years we've seen that. Overall, retail sales year over year ended up positive. Now, remember, that's excluding autos and gas and so on. So when you see the headlines saying that the last 3 months showed a decline in retail sales, they're referring there to all retail that includes things like automobiles and gasoline sales and so on. So we look at strictly either GAFO, GAFO, general apparel, furniture and other, and DSTM, department store type merchandise. We use those as indicators, and not a bad year overall, given everything that's going on. The holiday season ended up being a little softer than people expected, but still up, not a bad number. Interestingly, e-commerce has really leveled off. There were points when it looked like e-commerce was going to start to represent about 20% of total retail, but it leveled off, and depending on whose data you're looking at and what exactly they're measuring, we're running around 15% of total retail sales, and it seems to have stabilized there. Surveys are showing that shoppers are back preferring physical stores. They're preferring to go into a store to do their shopping by about 2/3, roughly 67, 68% of the surveyed shoppers are saying that they still prefer to shop in a physical store. So that's a really good sign for retail. Sales, inflation's definitely taking a toll. The consumer is spending, but they're trading down. They're moving down to lower priced goods instead of the higher priced private brands. They're moving to this in-store brands and so on. The Dollar General guys are doing big numbers, and that reflects this business of looking for less expensive alternatives to daily goods that we're seeing. Neighborhood centers are on the upswing, very strong, very low vacancy rates, climbing rents. On the other hand, the regional mall business is still getting hit hard, and we see that continuing for probably the next few years. It'll be interesting to see how that plays out long term. We're going to talk a little bit about that in the predictions part of our discussion today. You saw this slide last year, but I put it back in as a reminder. We have a lot of these mall properties, large and small, A and B centers, A and B shopping centers in the top 50 and then the next 50, so top 100 markets. And that data hasn't really changed. We still think that there's a very large amount of these centers that are Class C or worse centers, and they're going to have to be dealt with. Here in Connecticut, we've seen Enfield Square Mall, Crystal Mall down in Waterford just got sold, Trumbull Mall just got sold. They're all struggling to one degree or another, and a lot of the marginal properties are going to end up needing to be redeveloped, and we'll talk about that a little bit more later on. The restaurant business, hard to get great data on restaurants. We use the National Restaurant Association data for the most part to look at what's going on. Remember, this is an industry with a lot of churn in it in a good time. 90% of new restaurants close within the first year. So there's always a lot of churn. The question in looking at today's data is, what's normal churn and what's new. And, we think that there's about 90,000 total closures that you could attribute to beyond the normal churn. In other words, attribute to the economic conditions. So that's tough. I mean, that's really tough on a lot of these, particularly the local operators. They were the ones hit hardest. Casual dining as well. It continues to be a difficult environment with staffing shortages and increased costs for food and labor. The result is we're seeing a lot of restaurants having to revert to reduced operating hours in order to be able to manage their operations. But again, what we are starting to see is the stabilization of the rates of closure, and we're hoping that's going to continue through this year. We are starting to see quick service restaurant expansions again, and the emergence of some new concepts. So early days for that kind of thing, but signs of recovery in that business as well. Hotels, really a remarkable story. Just in the last half of last year, U.S. passenger traffic is almost at 2019 levels. One of the big drivers here is how millennials view their life in terms of getting experience with travel versus over acquiring material goods, if you will. And that's a lot of what's driving some of this travel. Really, it is a return to pre-pandemic levels. Particularly the leading group here was the resorts and tourist business. People just wanting to get back out there and enjoy their time in resort operations or tourist locations. Business travel still a little bit slow, but we're starting to see a return of the conventions and events and people going to them. Extended stay is a really interesting part of the recovery story here, because that's probably been the most active part of the hotel industry in terms of new development that's being planned. Like restaurants, hotels are having real trouble finding and keeping labor. And I think that's likely to continue, although improve as the market tightens up. The interesting part, and we've seen this in a lot of categories, is the amount of mobile usage that is being employed for people to book hotels. So, used to be everything was done on websites on your computer. Increasingly, and you can see from the data there, about 2/3 of hotel bookings are now happening over a mobile app on the phone. And the additional part of that is the expectation people have of being able to use their phone to check in rather than go up to the front desk, and also use it to get into their room. so that you can go in. I've done this myself a couple of times recently. You can go into a hotel, basically never talk to anybody and get into your room, check out, same way. With the work from home and the blending of travel, what we mean by that is, what we call, you'll hear called digital nomads. These are people who can work from home all the time, and they've decided they're going to travel while they're working from home. So they're blending this experiential travel that they want to do with their employment. And we talked to somebody just recently who spent the last 3 months in Vietnam, and I wasn't even aware they were in Vietnam, but they've been working from Vietnam, and they plan to spend the next year traveling, working and traveling all over the world. And I think that's going to be with us for the foreseeable future. The interesting forecast for the global industry is a compound annual growth rate of 8% through the end of this decade. So we're going to see robust growth. They've gone through a real tough time. We saw a lot of hotel rooms come out of inventory, but we're expecting a lot of growth going forward. So to set up a little bit for the next part of our discussion here, I just wanted to put this slide up to remind people what millennials are, because we're going to talk a little bit about that group. So that's the 1981 to 96, born 1981 to 96. We actually typically use 1980. You'll see some data that says millennials started in 77, but we think 80 to 96 is pretty reliable. Millennials are now a bigger group demographically than boomers. So we're going to talk a little bit about that going forward here. Single family residential, we're starting to see that return to historic norms. And what that means in this case is that the market's slowing down and prices are getting a little more reasonable, and time on market for sellers is going up. So more of a balance between the buyers and the sellers than we've seen in a lot of markets for the last few years. Some of the hottest markets, Austin, Texas, Phoenix, Atlanta, and so on. I mean, we're expecting to see significant declines in the sale prices of homes as they start to normalize back to what we typically expect for regular levels. But even with that cooling off, the Sun Belt markets are still very active markets in single family sale residential. Interest rates, huge effect on this, doubling the cost for people that are buying. But keep in mind, over this past 40-year period, the average mortgage rate was 7%. So, we think that sure, it's having a dampening effect on demand right now, but we think the market will adjust and people will learn to accept these high rates and decide that they don't want to put their plans on hold in the expectation of being able to get mortgage rates back in the 3s again, or 4s. Build for rent started to slow down a little bit, but we think that's temporary. We think that build for rent market is going to come back. It's very dominated by small players, but we've seen dramatic entries from institutional players. So 2019, 56,000 of the units in build for rent were institutional. By 2022, that number had virtually doubled to 119,000 units. It's expected to increase by 2027 to 188,000. So we're seeing that market continue to grow, particularly in the Sun Belt and southeastern markets. And here's the point that I was sort of setting us up for on this discussion about millennials. 83 million millennials that are outgrowing apartment living and starting to look for housing. And build for rent may be an option. They may be in a position to buy as well. But it's something that we're spending a lot of time watching and looking for trends in different markets. And I think that's going to continue to be the case. Multifamily apartment development, still very much in favor from an investment standpoint. However, rents and rent growth definitely showing signs of weakness, and so a little bit of volatility. Very much a market-specific phenomena. We've seen this weakness in the markets which have been the most aggressive for the last number of years. Huge increases in rent year over year, and that started to cool down, and we think that cooling down will continue. We are not really seeing that in the north central Connecticut or most of the Connecticut market in this. There's still reason to believe that reasonable rent growth will continue to occur. Keep in mind, the rent growth is really critical to a lot of development planning. We do a lot of financial feasibility, and for a long time now, the financial feasibility of a given apartment project has been very much dependent upon being able to predict fairly steady and significant rent growth year over year going forward. If that, as we believe it will in a lot of markets, if that levels off, and then that's going to change the dynamics of these projects. Impacts on the development activity in the multifamily rental residential, typical ones you'd expect: inflation and economic uncertainty, interest rates, cost increases, some of which have been huge. This leveling off of rent growth, as I mentioned, and of course, all this leads to financing being harder to find. Self-storage, still steady, plods along with continued growth, more growth in climate controlled, and we're now starting to see interesting formats in self-storage. We looked at one in the south just recently. It bills itself as a luxury self-storage, and this building from the outside looks like an office building. All glass clad on the outside. If you were driving along, you would think it was an office building. The entrance to it is a series of nice looking bay doors that they can literally drive box trucks into for the contractors that use self-storage, and for typical consumer users as well. And once they're inside a climate controlled loading dock area. But I mean, this is the nicest loading dock area you've ever seen. So people can unload their goods, or the contractor can access his storage from this tiled, brightly lit, air-conditioned interior space. And they're pretty impressive. And I think we're going to see more of that kind of self-storage format. By the way, that project also has one of the 4 walls is a green wall, completely planted. Looks great. And that's, I think, going to get a lot of communities a little more willing to accept self-storage development in their community. Warehouse logistics, big engine of growth, continues to be, and we think that'll continue, particularly in our area, for some time. But we are seeing a little deceleration in that market in a few of the markets that were really hot in the last few years. However, vacancy continues to be at record low. Again, it's market specific. Some markets are great, some markets are slowing down, and other markets are sort of somewhere in the middle. Facing cost increases and interest rate pressures as well. A lot of it under construction the third quarter of last year, and we'll continue to see that, I think, for the foreseeable future. This is a slide that if you were on this presentation last year, you saw, but this is just north central Connecticut and tracking everything over 100,000 square feet, distribution centers in our area over 100,000 square feet built in the last few years. So our watch list, we're continuing to watch the casual dining segment. We think that's going to need to be watched for some period of time going forward. Again, like I mentioned earlier, these are the local folks primarily, and they struggle with low liquidity levels. They went into the COVID with low liquidity. They got some rescue funds, but it hasn't typically been enough for a lot of them. And then staffing, and then ingredient cost increases. So any of those are still good reasons to continue to watch what's going on with the casual dining segment and the local dining segment. Office, obviously, and particularly the older office projects. I had this conversation with someone the other day, and they were talking about, well, the building is only, it was built in the 80s, so it's not that old. And I had to point out that that's a 40-year-old building now. And as I've heard before in my career, the reaction was, sort of, are you telling me that depreciation is real? And I had to say, oh yeah, you bet. And when you start to get an office building, or any building, retail or office or anything else, once it's over 50 years, I mean, now you're talking about what's left that's usable is often only the structure, the skin, the mechanicals, almost everything has to be replaced. And that's a big investment, a daunting investment. We have a lot of those buildings in north central Connecticut that are 50 and 60 years old. Regional malls, they're going to stay on our watch list for a while, as I mentioned. So we are talking to municipalities about doing inventories of their older buildings, so they're a little prepared for what they may be faced with going forward. How did we get here? COVID gets blamed for a lot of things, but a lot of this stuff really had its origins back in the 90s, when we simply got too much retail, particularly built, and in many markets, too much office square footage. Retail, US retail is about 22 to 24 square feet per capita. Canada's 11 to 12, and Western Europe's 8 to 9. So you don't need to get much more data than that to realize that the US ended up with a lot of retail space. And as many of you have heard me say, I like to say that it's not that we're overbuilt, it's that we're under demolished. Some of this stuff has just got to go away. Back to this old building discussion, a lot of these aging assets really suffered from underinvestment. Owners that didn't believe retail, or didn't believe, pardon me, that depreciation was real, and didn't invest where they needed to as the years went by to keep the property up. And now they're in big trouble. The numbers are just daunting. COVID-19, as I said, certainly made things worse with the growth in online, and of course the hybrid work that we're facing now. But we'll see market corrections occurring as we go along, and they'll continue for the foreseeable future. So 2023, some predictions, and we've got a few of these here. The obvious one is interest rates. We think at least another 100 basis points, another 1%. Is pretty much the minimum that we're expecting for this year. Could be a little higher. We think that this bid-ask spread between buyers and sellers will close up, and actually we're starting to see signs of that. Sellers who are sort of recognizing that the world's changed. It's not likely that they're going to see conditions that they saw 2 or 3 years ago, probably 3 or 4 years ago now, I guess. So we're seeing a little more rational behavior on the part of sellers. Cap rates can continue to kind of come up as the interest rates come up, of course. Financing criteria will continue to tighten. We saw a lot of that last year, 22, particularly the last half of last year. Tighter criteria around debt service coverage and loan to value tests, and preference for sort of the best markets versus marginal markets. We expect that commercial real estate foreclosures and defaults will continue to rise. There's a lot of market correction in both retail and office that's got to occur. And we think that's going to continue for the next number of years, in fact. Good and bad. I mean, there's opportunity in all that, as we've seen. There are people out there that are buying regional malls and finding ways to make them make financial sense. Office is going to continue to suffer, including in the major markets. No one's going to escape this trend. Everybody's going to get hit. One of the things that we monitor is the feds. What are they doing with their stuff? So the General Services Administration, they're roughly almost 8,000 leases and 180 million square feet of space with about 5.7 billion in annual rent. And then the stuff they own, which is about 19,000, a little between 19 and 20,000, over 500 million square feet of office space. So the real estate roundtable got together in the early half of last year, and they ended up sending a letter to the government. And this was a quote from their letter. As of March 22, more than half of GSA's leases, which account for more than 88 million square feet of space, have expiration dates scheduled for calendar years 2022 to 2026. So in the next 4 years, all that's coming up, that 88 million square feet. And you can imagine, I mean, the impact on local communities of the GSA saying that they only need 2/3 of it, half of it, that's going to be a dramatic impact. So the real estate roundtable stepped up, and it was a good thing for them to do, and wrote to the feds and said, look, while you're doing this analysis of your space needs, please keep in mind the impact on the communities where these buildings are, the owners of the buildings, and the investors that are behind them. So that's just a small snapshot of one of the biggest office users, but it's maybe a bellwether for what's going on generally in the industry. So I get asked this question: are we headed for a crash? Are we headed for a recession? No, we don't see that at all. We see this as being sort of a soft landing, short and shallow. We might get through it by the end of this calendar year. As I mentioned earlier, 40 years in this business. I started out working on a project in Calgary, Alberta, and our construction loan our interest rate on a construction loan was 21 or 22%, and we made it work. We've seen the global financial crisis. We saw the savings and loan crisis. If you look at the data from those times, I mean, there's nothing that we're seeing now that comes close to the peaks and valleys that the industry incurred during those times. So we don't see it as being that bad. We see it as largely a market correction in the aftermath of this pandemic, and some changes in the market that were happening already, but were accelerated by the pandemic. And we think that the market will recover. And we're actually quite optimistic that 24 and beyond are actually going to be pretty good recovery years. So stay tuned. We'll see. If I get invited back next year in January or February, I'll tell you whether we still believe that. We're going to see continued growth in the Sunbelt markets. There's going to be some corrections, as I mentioned, Austin, Texas, and a few others. But there's no question when you look at the data, 6,000 net new residents moving to Florida every week, roughly 8,000 net new residents moving to Texas every week. Markets like Phoenix and some of the other Sunbelt cities out west. We think that's going to continue, and that's going to bring with it some corrections, both in the markets that people leave and the markets that they arrive in. Certainly 2023 we're going to be faced with these headwinds of market uncertainty and cost volatility and interest rates and the cost of debt and equity and this flight to quality that we always see in times like this. We've been to this movie before. Again, we don't see this as big reasons for panic. CMBS deals, and this is another small data point that we threw in here because we think it's sort of indicative. 28% of CMBS, this is December data, and I think it was based on November numbers, but 28% of CMBS data, or about $5.5 billion, are in a negative leverage situation. Much of that is in the warehouse industrial storage market and the multifamily rental residential. So, that's interesting, and we'll have to watch and see. Most of that is in these overheated markets in the South. So that's where a lot of the big corrections are going to see. We're going to look at our markets here. We're going to look pretty stable by comparison. Real estate industry hiring down dramatically. That's what happens in times like this. As the industry starts to recover, we'll see that reverse. Certainly leases, it's become more of a tenant's market, and the availability in certain properties has definitely started to increase, particularly in the B and C properties, in all sectors, basically. So owners are facing this tighter criteria that I mentioned. Keep in mind this past expectation of rental income increases, with that sort of reversing to the point where we think that that'll now be in many of these markets, particularly those overheated markets that I've mentioned, that's now going to flatten out and almost be in a decline situation. That's going to change things from a financing standpoint, and it's going to change appraised values, of course, and how lenders and investors feel about them. And again, we're going to see that flight to quality to the A markets and the A properties. Tougher leases in retail and office, as I mentioned, the tenants market. The reality is, look at population growth. If there's no population growth, we're just not going to see particularly retail or office development of any scale. There's just no support for it. We're going to see a lot of attention in conversions and replacements of obsolete retail and office properties. And that's an area, we're going to talk a little bit about that in a few minutes, but that's an area of opportunity. And if you're looking for opportunities, that's an area to really pay attention. A lot of times this stuff, the retail and office property that are functionally or market suffering from either functional or market obsolescence, they're in great locations. They're great pieces of real estate, often in pretty good markets and well located. They just need to be something else. And if you can get them for the right price, they represent a real opportunity. More interest in suburban, less interest in urban, for obvious reasons having to do with what's going on with CBDs. We are going to see some developers fall and some projects fall, particularly victims of the interest rate increases, but also, piling on with the cost, materials cost, construction cost increases, and flattening market activity. But we are particularly concerned with some of the smaller developers who have gotten into particularly apartments in the last few years. And, they look the same. They really haven't done much of this before. maybe never done a project before. They're doing a relatively small project and they're kind of getting in the game late. And whenever we see that, they're the ones that tend to get hurt the most and most likely to get hurt. So we'll see what happens. Hopefully they can pull back and maybe wait with their project to fight another day. But there's a history of that happening with these less experienced developers. We're going to see continued development of the apartment projects, the high quality, amenity rich projects that we've seen here, particularly in north central Connecticut, but right across the state for the last few years. Very strong demand for those, largely because of the old stock that we tend to have in many Connecticut markets. You know, up until recently, a lot of the apartment rental projects in these markets, the most recent of them were built in the 80s, and they were pretty tired. So there's market demand for these new projects. We're going to see, as landlords try to find ways to make their buildings, their office buildings relevant, they're going to look at some of these things we've listed here: open air, greater flexibility, emphasis on all these technologies around security and environmental issues and flexibility and so on. Specialty retail, we think we're predicting is going to continue to be anemic. We don't see that coming back in a big way. Again, this is the millennial generation and their impact. They're far less interested in the latest fashion or, the acquiring things, and they're far more inclined to spend their discretionary funds on things like travel and so on, experiential travel. Now, having said that, there is an element of experiential retail that we're seeing, we've been seeing emerge for the last number of years. COVID accelerated it. We think that's really going to be a growth area and a place where retail landlords can look to backfill some of the vacant space in their projects. As I mentioned, regional mall values, bad outlook. Neighborhood centers, strong outlook. I should have, before I flip there, cannabis. I mean, you can't pick up a newspaper right now without reading about the impact of cannabis retail. So we'll see where that goes. We're going to see a lot of them open, and we'll probably in a year or two, we'll see a number of those close up as well as they oversaturate the market. Characteristics of projects, just a few comments on that. Projects, retail projects, quick service restaurants and banks, they're all working on smaller prototype buildings. Quick service restaurants are very concentrated on new formats that are delivery only. In other words, no dining. They'll have 4 drive-through lanes, and we looked at the prototype for that late last fall. 4 drive-through lanes, 2 of which are for DoorDash pickups or just customer pickups, and 2 of which are the traditional drive-up menu board kind of ordering process. But 4 drive-through lanes, no dining area, smaller prototype. Definitely freestanding. A lot of these guys that used to be willing to go into, especially retail stores that used to go into shopping centers, are much more willing to look at freestanding, especially if there's a building they can get their hands on and convert it at a low price. Increasingly, some of these users are looking at their stores or their physical locations as a billboard or a fulfillment center. In other words, a place where people come to pick up what they ordered online, or a showroom for people to come and look at goods. So not necessarily the traditional philosophy about a retail location, more of this way to enter a geographic area that gives them an edge over simply a website. So by establishing a store, they end up with an entrance, if you will, into a new geographic area. So what they have found, and we see this data all the time in a couple of segments that we're active in, is that every store they open or every location they open in a new geography actually results in increased web traffic from that geography. So that begs this question, or goes back to this question of the store operating as kind of a showroom and billboard. It's driving web traffic as well as operating as a fulfillment location. Definitely the prototypes, we call it frictionless. It's a place where people can buy online and pick up in store. They can get curbside delivery, or they can order it and have it delivered from a local location rather than waiting 2 or 3 days. And that's going to be key to retail development and conversions going forward. Multifamily rental residential, we mentioned amenities, but also STRs, short-term rentals. We haven't seen a lot of that in the Northeast, particularly in our markets, but in the South, we've seen a number of apartment projects where the developer will dedicate, for example, an entire floor of the apartment building to be a short-term rental operation, sort of like operates almost like an extended stay hotel operation. And we think that's a good option, especially when there's market corrections occurring and they need to have a way of bolstering occupancy. We talked about new designs in offices and hotels, more formats. We're already seeing that include residential options. So half the hotel is a traditional hotel, and then several floors are pure residential, longer term stays. And this is catering to a large degree to digital nomads, these people that we talked about earlier that want to stay in a place for 3 months and work from there. They don't want to do that in a traditional hotel, but they'll look at effectively a short-term rental. Development opportunities. Apartments, as I mentioned, we see continued demand for these upscale, amenity-rich projects, largely because of the old stock. Also growth in this where there's job growth. Locations are those which the best locations are those near the transit corridors and within walking distance of food and beverage and recreation opportunities. We've listed a few of the markets that we think are going to continue to be active, including the North Central Connecticut market, the Hartford market, and I mentioned the integration of short-term rentals into apartments. Industrial, definitely an ongoing opportunity from a new development standpoint. Just lots of reasons why we're a great market for that, and including that the labor market is available in this area and near similar uses. You know, if you went back to that graphic I had a few slides earlier, you could see that concentration. That's attractive to the end users of the industrial development projects that are underway. Redevelopment, moving from new development to redevelopment, we think there's a lot of opportunity in this and will be for the next number of years. A couple of things here, got to be supported by very strong research. Do the conceptual planning that's necessary, and that isn't just greenfield architectural designs, that's figuring out how to convert an existing retail or office property into something that the market today will support. Community engagement, critical to start that early in markets here in New England, just because of the engagement that most communities have in their land use decisions. And of course, the current environment just requires everybody to do everything they can to minimize their risk. There's a low tolerance. The operating premise here is that you've got to be able to buy these properties if you're going to redevelopment at a very low cost per square foot. And we're seeing them trade, you know, we've seen some of this stuff trade below 20, and in fact, a few large properties below 10 a foot. And you've got to be able to do that because, as I mentioned, your reconstruction is dramatic. If these things are 50 years or older, there's a structure left. It might, for that matter, include demolishing the whole thing and treating it simply as a great site and not as a building that can be converted. On that conversion, again, lots of opportunity going forward here in Connecticut. These offices, office buildings and office campuses, converting them to some of the uses here, the warehouse industrial uses or apartments or self-storage, or maybe a blend of all of them if the site's large enough. Retail conversions, lots of different kinds of uses that retail sites and buildings can be converted to. You know, I've listed a few of these here. Some of them you're familiar with in the Hartford area, the food hall conversions, again, back to experiential. The real focus should be on those two uses for retail conversion. The real focus is likely to be on those two uses in red, food and beverage and arts and entertainment. That's really what's going to drive a lot of this activity in these retail locations going forward. That more than anything, we think will be the big rationale by which developers will be able to acquire these properties and make them make financial sense. Other uses, last mile logistics, co-working spaces, incubators, and so on. adding multifamily rental residential onto an existing mall parking lot, for example. We've seen a number of those occur. And again, these are good sites. And usually once they're converted, they don't need the 5,000 parking spaces that a 1,000,000 square foot mall has, because it's just not going to be 1,000,000 square feet of retail anymore. So you can literally plan to use those vast areas of parking for a different use. Converting enclosed regional malls back to open air or mixed use properties. We've worked on a number of those. They can be very successful. Other opportunities in Connecticut, we're continuing to see out-of-state investor interest in Connecticut, and we think that's going to continue. The reasons are, pricing is better than they're seeing in their home markets. A lot of these markets here in New England and Connecticut are perceived as being relatively stable versus some of the markets that they've been working in, for example, in Texas. Less competition in Texas, Dallas, or Austin, or Atlanta, or Phoenix market. Every site has got a lot of people chasing it, and that drives up pricing. Just less competition here in our markets. And then there is a lot of existing aged properties, and particularly with respect to amenity-rich apartment development. Out-of-state investors are looking at those aged properties, that concentration of aged properties, and saying that if they come in with a new project, they can pull users out of these older projects. And even without a population growth trend here, they can offer a new product and fill it up. And the proof there is all around us. We're seeing all of these projects, these new projects in apartments, amenity-rich, high-quality projects filling up very quickly. These guys are coming in, but they need liquidity, and they need to come in with a plan. Nothing new about that. This is a slide that you've probably seen before. We drop it in here in all our presentations because we think it's so important. I don't know that we've got anybody from a municipality listening in today, but this is our advice to municipalities that are calling us about what's going on in their community with respect to particularly office and retail. But it's to be proactive and don't wait to respond. Review their zoning and permitting criteria and improve them, make them more business friendly, and generally improve their processes so that it happens quickly, it's simple and understandable, and there's certainty to it. Remove the discretionary language that a lot of Connecticut communities put into their zoning codes in the last number of years. Incentives, like it or not, if you're a municipality and you're trying to encourage development, incentives are a fact of life. I don't think we've worked on a project in the last 4 or 5 years, and that's probably over 100 projects now, where incentives, public incentives, tax increment financing, tax abatements, tax fixing agreements, waivers of building fees, all of those things. We haven't worked on a project in a long time where those kinds of incentives weren't necessary. They're just a fact of life, and communities have to get their head around that if they want to attract investment. These templates are going to change. What we think about as commercial real estate and what municipalities think of as commercial real estate is changing, and the towns have to change with them. And that means updating their zoning code to reflect what the market is looking to do. So let's make some assumptions here in summary. As long as the geopolitical instability doesn't get worse in these markets, we don't have another pandemic or something similar. We don't have a change in interest rate expectations or an energy crisis of some kind or some sort of unexpected shift in key economic indicators. It's actually looking like a pretty good horizon post the end of this year. We think, in summary, it's a good time to, if you've got quality assets, there's a lot of money chasing deals. It may be a very good time to look at selling those assets and redeploying that capital. You may get historically good pricing if you've got an A asset in an A market. There are a lot of opportunities for redevelopment at lower cost. We're seeing emerging demand, not only in new retail, but we expect to see it. We're seeing it in new retail, new hotel, but we're expecting to see it in new food and beverage offerings as the recovery continues. And again, there's an enormous amount of capital chasing a lot of deals. So try to get out in front of them. We still have some headwinds, inflation and interest rates, but been to that movie before and we got through it just fine. And again, we don't think it's going to be, this one's not going to be anything like some of the tough ones we've seen before. So the cycle that we were in has ended, but it's not the end of the world. As usual, as we come out of these kinds of situations, there's a lot of opportunity, and we encourage everybody to be looking ahead at where that opportunity might lie for them. Old quote, you've seen it before, but I think it captures things quite well. A lot of confusion out there, a lot of, gee, we've got good stories, and then we turn the page and look at another data set, and there's a terrible story. So I think we're going to see that. We've seen that in the last few years, but I think, as I said, we're expecting that we'll come out of this pretty well, and the market will offer a lot of opportunity. So, Stephanie, let me throw it back to you.
Yep. Absolutely. Thank you very much. That was awesome, Mike, and optimistic, which I wasn't sure I was expecting. So I like that. We have a couple of questions, so I'll start digging through them for you. Let's see. First is the cutback in the number of units to be built on the East Hartford Theater property a sign that the Connecticut market has reached its capacity?
Yeah, I would say the answer to that is clearly no. I think the capacity is definitely there. I think the cutback is really a reflection of the tightening financing market. I mean, there's a risk aversion that's occurring out there. Lenders are getting skittish, understandably so. I have a lot of friends who are lenders and talk to them all the time. And I think there's a real concern about what the next 6 months are going to look like, maybe the next year. And they're still anxious to do deals, but they want to minimize or lower the risk profile. And I think that's what's reflected in that change in number of units in East Hartford, not a lack of confidence in the ability to fill it.
I like that. All right, we even have even more coming in. This one is Transfer Act. Is there any progress with changes to Transfer Act in Connecticut? I'm not sure if that's one you want to
Yeah,
take.
I don't know that I can answer that. Mark Duclos is probably the guy to talk to. I know he's been very active along with a bunch of other folks in trying to advance that. I think the quick answer from what I've seen is that there has been some progress. I don't think we got everything that we were hoping as an industry to get, but there's definitely been some progress. And what I would say is, I mean, if that's an issue for you, get hold of Mark Duclos at Century Commercial. Tell him you're willing to help out, write letters or whatever you can do. I think we need to keep it in the front of legislators' minds. My experience with that sort of stuff is you have to make an issue of these things through at least 3 long legislative sessions before you see material change. So it takes years to change that. And Mark and the team working on that issue, I'm sure, can use everybody's support on it.
Yeah, absolutely. And anything that I've heard is, like you said, tediously slow, a couple years out. We do actually, I'm going to jump to a different question because we have one from Sam Haydock, who's also very involved with a lot of those environmental issues, and especially sunsetting the Transfer Act. So this is kind of blanketing with that last thing, but Mike, what are you hearing about our environmental regulations and the potential for change from out-of-state investors? I don't know if that expands further, if that kind of blankets into the last question. I don't know if you have anything else for that.
Yeah, it's basically sort of, I think it kind of answered some of it, but look, I think the out-of-state guys and we're working with a few of them right now that come in, they spend a lot of time trying to understand the Connecticut regs. And quite frankly, they're surprised by some of the stuff, particularly the Transfer Act stuff. And that's not good. I mean, that's a barrier to investment. And particularly in a market where we have all these older properties, that sort of puts a fine point on the urgency of making changes to the Transfer Act. We have so far, however, been able to convince people that some of the issues that are maybe a little alarming to them initially are issues that we as an industry have found ways to manage. And it's folks like Sam at his company that we refer them to get the kind of advice they need and the expert input that they need. But look, it's got to change. We are an outlier. Connecticut is an outlier in our environmental regulations. And that's a bad idea when you're trying to attract investment. So it's got to change.
Yeah, absolutely. Here's another one that I know you've answered it throughout the presentation, but maybe a more direct route. I don't know if you want to expand on that. The question is, where are the opportunities for investors in Connecticut and asset classes? And since most of your presentation went through that, I don't know if you want to say, if you had $10 million and it was you specifically, where would you go looking?
Yeah, I mean, it depends, I guess, on your risk tolerance. If you have a low risk tolerance, then apartments and industrial are probably your option. If you have a higher risk tolerance, I think the real money is going to be made in buying these great locations that are available at historically low prices, retail and office locations that are going to be and already are available at historically low prices. Now, you've got to have the stomach for conversion or redevelopment of those properties. But if you are in the real estate development game, I mean, if you are a developer, you tend to have a much stronger stomach, if you will, for that kind of. If you're strictly an investor, then you're probably better off looking at office at industrial and apartments.
Yeah.
So it's, look at it from a risk tolerance standpoint. But I can tell you from having seen repeated market crashes over the years, the people that I've seen making enormous amounts of money are the ones who sold good assets when pricing was at historic highs, waited a little bit, and then started buying when prices of some of these properties were historic lows, and then redeveloping them. I was in Dallas in the 89 to 92 period, and I can tell you a number of people that bought entirely vacant office buildings. They got caught with an office building that had just come out of the ground when the music stopped, couldn't lease it, sat there for a couple of years, and then sold it for a third of replacement value. The guys that bought those at a third of replacement value 6 years later, I mean, I remember one transaction very well. A group bought a series of those office buildings for 120 million, sold them 6 years later for almost 700 million. So, I mean, those are the big plays, but you got to have patient money and you've got to have the risk tolerance for it.
Yeah. That's crazy. We have multiple questions. So I'm going to try and batch them together on medical office space. I'll try and kind of frame them all together, but basically general thoughts on medical office space, how it will be affected by the hospitals purchasing private medical practices, and the growth of assisted living and other similar services.
Yeah, I mean, medical office to us is very much a relationship driven business. It's the acquisition of medical practices by the big healthcare systems is making it even more so. So if you have a relationship with the healthcare system, or you think you can develop a relationship with them, I think that's the right answer if that's a space that you are really interested in going into. If you don't have that relationship, you're just simply trying to lease it cold, and that can be in an era of increasing consolidation of that can be a tough situation. So it's somewhat akin to retail, where if you were trying to lease retail, a lot of times your ability to lease a retail space, certainly a lot of it depended upon the market, but a lot of it depended on a reliable relationship with the retailer. And we think that medical office is similar in that regard. So, if you're looking hard at that space, I think the first place you want to start is by trying to build a relationship with the providers and find out what they need and where they need it, and help them, make good choices about that. But just to lease, a medical office cold, I think that's going to get increasingly difficult. Assisted living, different animal. And there are, you have to slice and dice senior living into independent living, assisted living, skilled nursing, and then things like dementia and hospice and so on. So, I mean, that's market demand driven. We can do the analysis, and we have done a lot of that. that's simply looking at demographic and socioeconomic makeups of given trade areas, and looking at how much product exists in the trade area and the quality and age of that product. And then you can make decisions, data-driven decisions, about whether or not there's room for a specific type of product, whether that's independent, skilled, assisted, or whatever your interest level is. But no question, with the aging of Connecticut, I mean, that's a growth area, if you will. So I think it's worth a look. We have spent a lot of time doing analysis for some of the larger firms on exactly that question. And there's definitely opportunity out there, but you need to do that research.
And those people are staying in Connecticut, or are they moving to Florida, the people that need those services?
Yeah.
They're all staying. So I know we're running over on time a little, so I'll take these last two questions for you, if that's okay. We had talked about luxury apartment market, but what are your similar thoughts on affordable housing projects, considering towns are being compelled to offer more affordable units?
Yeah, I mean, that's we could spend another hour on that one. That's a critically important question. Finding answers to that question of affordable housing is probably one of the most important challenges the state faces right now. Dr. Don Poland here in our group, who runs our planning practice, we do a lot of affordable housing studies, and he spends an enormous amount of time doing research on affordable housing, public policy on affordable housing, and so on. We're not getting it right yet. And a lot of the reason we're not getting it right is public opposition to it, sort of the NIMBY opposition to it. And that's a shame. I mean, we don't have the public policy answer to how we can change that, but it really does need to change. We need to make it easier to be able to develop affordable housing if we're going to have a future here, if our economy is going to have a future here in Connecticut. We cannot become a state of retirees. That's a really bad idea, and we should feel a lot of responsibility if we hand the next generation an economy that is largely driven by older folks. I mean, that would be a terrible legacy for us to leave our next generation, and I hope we don't do that. But it's if anybody wants to reach out to us and talk about affordable housing separately, be happy to talk to you. As I said, it's an area of interest of ours, and particularly Don Poland's, and we're doing a lot of work in that area. I think there are solutions out there. The question is, we've got to get people in Connecticut, community members in Connecticut, not the political leadership necessarily or the staff in town halls. They all understand the issue. It's getting the average citizen in Connecticut to realize that affordable housing needs to be part of their community.
Mm-hmm. Same thread there with the NIMBY industrial warehouses. Are you seeing from your conversations with municipalities more moratoriums are going to come in place for, big, large logistics centers, or just general industrial warehouse kind of sweeping moratoriums?
Yeah, look, I think it would be naive to think that we're not going to continue to see pushback, and maybe increasing pushback to warehouse industrial. We're working on several right now, over 1 million square feet, and we're seeing that, no question. And they've got to be sited correctly, and they've got to be designed. I mean, if you're putting up a low grade Butler style steel building, no landscaping, and it's going to have refrigerated trucks running 24/7, you can't blame communities if they have residential areas nearby for being unhappy with that. But and we've seen good examples of high quality warehouse industrial built around the area. I think if developers come in and they take a responsible approach to community engagement and work with communities, I think that we can avoid the worst effects of those kinds of responses. But no question, we're probably going to see towns considering and probably passing moratoriums on it.
Well, thank you very much. Thank you. And for letting us steal a little extra of your time, 5 extra minutes.
That's all right. Happy to do it.
Thank you very much. We're wrapping up. So absolutely, feel free to reach out to us, and we will be working on sending out the recording and the slide decks we have. So, enjoy the rest of your day, everyone. Thank you again.